The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement. This is actually a live show today. Typically, we do a replay of the Saturday show, but we were preempted by the Baylor game. So this is live today, and our motto and our philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively, invest conservatively. And you always want to start out with your saving money in your company plan. Really putting away the money for retirement. Put away 10% plus the company match. You're going to get the 10% you put in, you're going to get a tax deduction off of it. You're going to get a company match, which is free money, and then you get tax-free growth until you retire. And then you simply pay taxes when the money comes out. It's not a bad deal. Actually, it's as good a deal anywhere you're going to get it in the investment world. And so take advantage of that. Build up your wealth. Save aggressively, put away the money, and then just conservatively manage it. And this is the biggest wealth creation tool the world's ever seen. And you can listen to the Max Out Savings Show. We'll kind of give you ideas of where we think the world's heading, in different strategies and our thoughts on this. And so. Long-time listeners of the show know that for years now we've been saying that commodities. You're going to see a shift to the commodities, and that's pretty much what's playing out this year. Increasingly, we've got really incredibly good numbers out of some of the sectors. You have this whole thing has been really put in place by the Russia-Ukraine war, where the United States, a small group in the United States, some neoconservatives decided they were going to fight a war with Russia, use Ukraine, and weaken Russia, and Russia would fall apart, and Putin would be gone, and it was all going to be good. And it didn't go their way. And then when they saw they were going to force Putin's hand, and they go, look, we're going to win this no matter what, and they just pushed all the chips onto the table of the American people onto the table in a massive bet that Ukraine was going to win the war. And the bet was, hey, we're going to bet the U.S. dollar, we're going to bet the financial system of the United States on this. And by that, the Russians had hundreds of billions of dollars at the Federal Reserve and treasuries, and we basically froze it. And so at that point in time, you better win, because you just bet the financial system and you just bet the dollar. And since then, gold has skyrocketed in price. Silver's gone up in price. Countries around the world are scrambling to find other places to put their financial assets away from treasuries. At the same time, we're borrowing $2 trillion a year the whole time, additional deficits. Our debts are now $37 trillion, and we have over $1 trillion a year in interest expenses. And so here we are, not in a good situation. We have less people buying treasuries, and central banks around the world now own more gold than treasuries. It was a foolish plan. It was, reckless plan in general. This is kind of what happens when you don't really have a president. You have a president that's senile, that doesn't know what he's doing, and you got a bunch of radical advisors underneath him that think they're smarter than everybody else. So here we are today. The dollar's going lower. The gold is up, and now we're seeing big changes happening every day in the world along these lines. And so this is the kind of the world we live in now. Now the Russians, the Russians, the Iranians, the Chinese, now the Indians, everybody is kind of going to one side. And again, a lot of this is just recklessness on our part for allowing this to happen, and understanding that the big battles between the United States and China, we need as many allies as we can. And so the question is, look, how do you play this in the world? How do you sit there and manage your retirement, which you have a retirement plan, and if you're saving for money, you've got decades into the future. If you retired tomorrow, you likely got 25 years where this money has to last you through retirement in this world. Now, in the last 15 years or so, it's been the S&P 500 who've been warning people that, look, the S&P 500 is heavily concentrated in a small number of tech stocks. We send out a max out savings report once a month, although they didn't come out once a month recently. We're going to be putting out a lot more here. But we really talk about this, and the top 10 stocks equal almost 40% of the S&P 500. I think 8 of those top 10 are basically tech stocks, and which is a very big concentration in the sector. And this is where the lion's share of retirement money is going. And most people managing money, quite frankly, are shattering the S&P 500 and just charging you a fee to do it. But there's a lot of risk. And we've been saying is, look, there's a different way. There's other areas. You've got to spread your risk out. You have to move into overseas sector. You have to move into things that can profit from a lower dollar. You have to purchase. You can't just be out in long bonds. In 2022, we had the worst year. I think the S&P 500 was down. Was it 22? 20, yeah, 22. The S&P 500 was down almost 18%. The long bond had the worst performance of in some people say in 50 years, some people say 100 years, and so this is just. And so when the people were in those things, they had horrible performance, and now they're heavily overweighted in the tech sector. But we're saying is, look, you have to spread your risk out. You have to be in real estate. You have to be in assets, and you have to be in commodities and things, because what we're looking at is $37 trillion worth of debt. We have $2 trillion. I keep repeating this $2 trillion every year of deficits, additional deficits, massive, over 6% of deficits. We've had 5 years of I think 1 year was a little underneath it, and 1 year was massively over, of about 6.5% of GDP deficits. We did the same thing in World War II. We weren't even fighting a war. We had a good economy. Joe Biden just figured he could spend as much money as he wanted to, and no one was going to say anything. The Federal Reserve wasn't going to say anything. And so here we are in a world today. So you have to be very cognizant we have a government that does not seem to be able to cut spending. Even with President Trump, the Senate doesn't want to cut a dime of spending anywhere, and they just want to keep recklessly spending money. And so are you going to sit there and have all your assets in dollars that you've got a government recklessly spending money? You have other people in the world not trusting them because they're worried that if the U.S. gets mad at them, they're going to freeze their money or freeze them out of the financial system. So you have to do the diversification. At the same time, the United States, we're in war with Ukraine. We're helping out Israel. We're emptying out all our munitions, all our missiles, all types of ammunitions out of our stockpiles so they're critically low in many cases, and the government's scrambling to sit there and rebuild them before a potential war that many expect. The number I've been hearing for years is 2026 with the Chinese coming into Taiwan. And yet here we are depleting our military ahead of time. And so we're scrambling to sit, so which when you need new ammunition, you need new missiles, you need new artillery shells, you need new drones. That requires aluminum, that requires steel, that requires silver, that requires copper, that requires lead. All these materials. Okay, at the same time, we're building out this massive AI, artificial intelligence infrastructure. The spending is so big over the next 6 months, the story is going to shift in technology to, oh my God, these people are spending ridiculous amounts of money. Where's it all going to come from? Is it going to fit there? Some of these plants are $50 billion a piece. I've seen some numbers even higher than Abilene, $50 billion for a huge AI facility. That requires huge amounts of aluminum, steel, silver, massive amounts of copper, all these things. It requires the electricity to produce it. So you've got to have windmills, you've got to have solar power, you have natural gas, all these things. You've got to have new transmission lines, more aluminum, more copper. And so what we've been saying is, look over here. This is where the difference is. This is, as we write about in our Max Out Savings report here, which we recently sent out, is look, the battle for AI supremacy is whoever controls AI has the best AI is going to win the wars in the future. So it borders on war. The buildup and defense borders on war. These are almost wartime activities of build out. That typically doesn't mean, if you look at those type of environments, that's not when commodities and industrials and manufacturing go down. At the same time, we're going to get, the number we've been using is $500 billion worth of factories coming back to the United States of America. And now Trump says it's $2 trillion, whatever. We cut the price and we said, look, this is what we think it's going to be. Those are jobs coming back to the United States. For the first time since, I think, 1995, when China entered the World Trade Organization, all they did was steal one factory after another of either lowball pricing, subsidies, stealing technology, whatever it took, they did. And nobody said a word to it. And then here comes Donald Trump. Donald Trump comes in. He's elected. He fights back. He loses the election in theory. He comes back, wins the election again. And this time he's got Stephen Marion, who's just put in at head of the Federal Reserve, not head, but as a Federal Reserve governor, which is a huge story, because what Stephen Marion did is he did the research and he said, look, free trade isn't working for the United States. He said, if you look at it, it works real well for corporate America. It works real well for Wall Street, and they're big winners, and everyone goes, free trade is great. But he says, if you look at it, working people are suffering. They're losing all their jobs, and those jobs are coming overseas, and they're the losers. And we can't run a country where the working people are the losers and the elite class at the top get rich with this. And so what he says is we need to have fair trade, and he's the architect of this, and most people don't understand it. It's the Mar-a-Lago Accords, and this is a big story. And what he stated is that, look, we're gonna manage trade for the United States of America, for corporate America, and for the working people. And we're going to go to countries, and if countries have big tariffs, we're going to put big tariffs on them. If they have blocks of different types of regulatory blocks on say, for instance, agricultural, then we're going to make sure that they don't let any of their agricultural products in our country. We're going to let the other countries set the trade negotiate. They're going to set the pricing. They're going to set the tariffs, not us. So when we raise tariffs on a country, the press goes wild that we're wrecking. All we're doing is mirroring what their tariffs are on us. And so this is a huge change. This means factories are coming back. And as I said, we got this big AI shift. We have this big defense buildup shift to try to go, prevent the Chinese from taking over. At the same time, we have a manufacturing shift back. So these are all exciting things happening to the United States, but they're probably not all the best for the big tech companies. It's going to be best for manufacturing. It's going to be best for commodities. It's going to be best for those type of things going forward. And it's going to be more inflationary. And so all of these things are coming into play, and this is something we've talked about for years now, and it's really almost remarkable how it's all playing out now, and I think it'll continue to play out, but it's going to be a different world. It's going to be a more volatile world going forward. And tell you what, we're going to come and talk some more about this right after this quick break right here on the Max Out Savings Show.
Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com. In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. Get any questions, you can give us a call, 713-339-1070. This is live show today on Sunday, which is unusual, 713-339-1070. Question about retirement, about the environment out there, what your thoughts are, give us a call. Now, we're just talking about the big shift happening more towards the commodity sector. There are different parts of the economy slowing. Housing is slowing down right now. So some of the tech sector is starting to slow down right now. And so we're kind of in a little trough. I think next year we're liable to see much more growth come in overall. Excuse me. But what I want to do is, I'm going to take a sip of water there, but one thing I wanted to talk about is electricity. Typically, when you produce electricity, when you use electricity, the cheapest electricity is in the evening and late at night. And why is that? Because some big power plants run all the time. The cheapest power is probably nuclear power. There's really not a lot of marginal cost to produce more nuclear power because the thing is running all the time. It's coal, same thing. It's kind of constantly running. It's the same thing. You got to feed more coal into it, and so then that's a little more expensive. And then you have your natural gas. Those seem to be more expensive. Sometimes they're cheaper. And then you have your solar and wind, just depending on the time of day. And so different power plants have different costs. And so the electricity companies, they'll use the most stable, low-cost power most of the time. That's kind of your base load, and that comes in. But as the demand goes up, for instance, let's say it's the summertime, it's 100 degrees out, there's massive demand for electricity because everybody's running their air conditioner. Well, in that case, they're using all the power. They're using the power. Some of these things are called peaker power generator plants, where they'll call them up and say, look, we need power for the next 2 hours. And they'll go, typically, Houston, I don't know what it is, it's maybe 14, 15 cents a kilowatt. That might cost 25 or 30 cents or more a kilowatt hour because it's the most expensive power out there. And so they just pay it, and it averages, it's not that much. This is why some of the companies offer free power after midnight, because there's not much usage, and the South Texas plant is running. It's probably costing them virtually nothing to produce the power, so they get a good deal on it. So your peak hours is always the top marginal cost for power. Well, that works when you have extra power plants all over the place, and you need them. You call them up, and even if it costs 50 cents for a buck in a kilowatt hour for the power, you don't care because it's a small part of the thing, and it's just every once in a while it doesn't really affect. Here's the problem. If you look at artificial intelligence they're projecting there's enough right now for 10 gigawatt of power needed coming on stream. And a big major nuclear plant does about 1 gigawatt. So there's 10 of those, but they're expecting 67 gigawatts. And in places like Virginia, they're already short on power. Now, why is Virginia short on power? Because it's probably one of the most dense places for AI centers because it's around government facilities. Obviously, they're using a heck of a lot of AI up there, and but really the biggest concentration of AI centers is around the Washington, D.C. area, but so they don't have the power. So their power costs are skyrocketing because all these AI facilities are running up the cost of power, and so the marginal, the peaker plants are having to run all the time, raising the cost of everybody. So power from last year has gone up about 3.75%, but in some of these other areas, it's up a lot more just because they don't have the power. And this is something that's not well understood out there. For all this exciting talk about AI and stuff, it's going to cost people money because their power costs are going to go up. And this is something, I mean, I really think that a lot of these AI facilities should have had to pay for the higher cost power in the public, which invested for years on the power plants and put all the money into them and the generation and the electricity networks and everything. They should have gotten the cheaper power, but they didn't ask me. And so and some of these companies are now signing up, reopening nuke plants to get super cheap power, when it's kind of like, well, wait a minute, why isn't the utility company opening it up and giving everyone the cost of the cheaper power? But this is causing a rise in electricity costs. Electricity costs on an average have gone from about 13 cents to 19 cents, and they're starting to really accelerate in the last 12 months. So this is something we want to keep watching. It's going to affect inflation, and because keep in mind there's more plants coming into the United States as well, and there's going to be a shortage of electricity. And so in the 1970s, we had oil prices skyrocketing. We could have electricity prices skyrocketing. And so this is just something to think about. But I really wanted to kind of just bring this up today so you understand, what we're dealing, because a lot of people don't understand electricity, and they don't understand that marginal bit of electricity used is at the highest cost. So when massive amounts of demand hit the market, it all comes in at a much higher cost. So the margin, if it's a nuclear power plant, they're doing it for 3 or 4 cents or 5 cents a kilowatt. They don't get that. Okay, that marginal cost is probably closer to, the average, as we said, is 19. That's probably maybe 30 cents or something like that for that higher end stuff. This is why inflation is sort of not going away and something we want to keep watch. Now, again, all of that requires massive amounts of build out of manufacturing, of machinery, a build out of power lines, of all types of stuff across the board that these companies need. Everything from turbines to electricity lines. They need copper, they need silver, they need tin, they need zinc, they need lead, aluminum, all of these things. And this is why you're seeing the prices of different metals go up. Gold is up this year. It's pretty much, I think, the number one performing asset or close to it, major asset. It's up 36%. Silver's up 41% year to date. And so we've seen massive cost. Now, copper hasn't gone up as much. I think you're going to see copper go up. Now, the interesting one is, I just hit the wrong button on my computer. The interesting one is copper, but I think copper is about even year to date, but I do think you're going to see that one go up as well. It's up, but not as much. And that was simply because so much copper came to the United States when they thought they were going to tariff the copper. And so it dropped from about 580 down to 447. So that's an opportunity. But so anyway, so what you're looking at with your retirement is you want to understand, you want to be in these different asset classes. You want to be spread out. Overseas markets have done quite well this year because they're materially cheaper than U.S. markets. If you look at different things like that. Oil and gas. If you look at oil and gas is down year to date. Now this is an interesting one. The West Texas crude is down about 14% because basically Trump has come in and said, drill, baby, drill. Well, people kind of made a mistake with Trump to some extent. Trump is looking at oil. What do we say? The big drivers, what you got to do is you have to step back when you're in the investment world making long-term decisions for retirement and look at the big trends. And one of the big trends is this $37 trillion worth of debt, the $2 trillion worth of deficits every year. How do you the interest expense is the number 2 expense now, I think it's ahead of defense in the United States. Well, if you can get interest rates down, that will help you out. If you can get the dollar, if you can get interest rates down, well, one thing you need is inflation lower. One of the biggest components in the CPI and the PPI is oil, gasoline, natural gas. All of those things are in there, and commodities and things. Well, those are all petroleum based. So if your price of oil drops, it helps out your commodity, it helps out your inflation. So by pushing as much drilling as possible, talking about opening up different countries to let more oil in, that is pushing the CPI down. That is helping Trump get the Fed to cut rates. The interest rates on the short end of the curve, this is kind of a parlance in the fixed income world, which is just your shorter term bond, 2 or 3 year interest. It drops. And Secretary Bessent made the comment, I think he wanted 150 to 175 basis point drop in interest rates. Well, with oil dropping, it's kept the CPI down, and it's helping out the situation. We don't think that that's going to long-term work, but for now, it is. Right now, the Fed funds is about 4.33%. Now here's some numbers on this. The United States, and this is why Trump is upset with the Fed for not cutting rates. 2 things. He wants interest lower, and he also believes the Fed should work with the government to achieve certain things. So if you want to try to get the deficit down, you want to try to work to get the interest down as well. And you can't have the Fed raising interest rates, and you're trying to cut interest rates, and you're trying to reduce the deficit, and they're raising rates. But this is what they're looking at. Okay, so you understand that the average maturity of all U.S. $37 trillion worth of debt is 5.5 to 6 years. Okay, stick with me for a second here. It's a little complicated, but to keep interest rates stable, you need which means it's 5 to 6 years. Now, keep in mind, 2 years ago, or a year and a half or 2 years ago, interest rates were much lower, and we started raising rates a couple years back, but they were incredibly low for a long time. So a lot of this is at lower rates. So in order to keep interest rates stable, yields need to drop to 3.1%, a drop of 1.323%. Okay, so what this is saying is, if we just do nothing and don't borrow any more money, and the Fed funds stay at 4.33%, and the yield curve stays where it's now, interest rates are going to continue to climb. They're over $1 trillion right now, and our deficit is going to go up because we have to pay. We got to find money to pay for the interest, and so the interest rates go up. But if Trump can get the rates down, as we said, if they can get them down about 1.25% out to maybe 5 years, that's going to help them drop interest cost. And this is why the big battle is going on out there. This is why you hear Trump so upset and Secretary Bessent so upset about interest rates. It's not that they're trying to goose the economy higher. It's that they realize, in order to get the deficit down, they've got to have a multi-pronged approach. They have tariffs. They're coming in about $30 billion a month on tariffs, which is what was at $360 billion a year, something like that. Okay, they also are counting on an economy growing some more, which is going to give them more income. They're counting on cutting government spending. The Doge Commission found about $250 billion in cuts. So there's $250 billion plus the $360 billion. So that works out to be maybe $400 billion or so. And then if they can get some cuts where interest drops as well, a couple $100 billion, then that starts making a big dent in the deficit. And then people have more confidence in the United States of America that things aren't going to spiral out of control. Then interest rates go lower and it'll stabilize the situation. And so this is why the big battle you hear about interest rates with President Trump and the Federal Reserve, it's not about Federal Reserve independence. They do want to be able to do whatever they want, but it's about, guys, look, the Federal Reserve has said nothing about the $37 trillion worth of debt. Joe Biden every year ran up $2 trillion deficits recklessly every year. Not a word from Jay Powell or the Federal Reserve. Never once did they say, hey, guys, we can't keep spending money. And so, but now people are seeing they're becoming nervous around the world. And so this is what the big battle. We'll see if the Fed cuts rates here in the next week or so at the Fed meeting, what's going to happen there. So anyway, it's kind of a long-winded, very complicated explanation today, but I want you to understand why these big trends are happening. We're seeing these big trends. As we said, we got this big trend where Trump is trying to force down interest rates and battling the Fed. We have this big trend where there's hundreds of billions of dollars worth of manufacturing coming back to the U.S. We have this big trend where we've got not just the reindustrialization, but the buildup of our defense. We have this massive AI, artificial intelligence trend of these, hundreds of billions of dollars worth of data centers. And at the same time, we have a situation where we have this massive deficit that people are concerned about and stuff. And so we're going to live in a more inflationary environment. If you add the tariffs in place, if you add the tariffs, if you add the increases in manufacturing, if you add in the increases in electricity, all that's going to be more inflationary. So inflation's not going to go away. So what they're going to do is something called yield curve control or financial repression to push interest rates down. So you're not going to be paid as much on your government debt because the Fed's going to manage it down. Ultimately, this is what it's going to have to be so they can try to stabilize the whole situation. Now, that'll be good for the market over the long term, but right now the economy is slowing, hiring is slowing. The illegal aliens are in the country. There's probably 30 million of them in the country. Some of them came across the border last year, probably 2 or 3 million of them, but there's a lot of them that have been here for 5, 10, 15, 20 years or more. They're all nervous. They're not rushing. If you're an illegal alien, and actually I did my report and I had Grok look at it to kind of proof it a little bit. It came back like, Ted, you can't use illegal alien. I'm like, yes, I can. But if you're an illegal alien, you're like, you might have a good job, you're pretty well set, you got kids in school here, but you're not going to go buy a new house. You're not going to buy a car because you're worried you're going to get caught somehow. And so you're just laying low. You're going to go to your work every day, come back home, and you're going to go to the grocery store. Well, if one person does that, it doesn't really change anything. But if 20 or 30 million people kind of do the same thing, that's going to slow down the income. That's why we're going to see the slowdown here later this year. And so, and I want to kind of go over this. I mean, tell you what, well, we're coming up here in a break. I'm going to expand upon that about kind of what I'm thinking here because we've made a few changes in our portfolios, and I just want to give you an idea of what we're thinking. We'll be right back after this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. I just want to mention one of our sponsors, Rangoni Alto Gin. It's a fine botanical gin out of the Italian Alps. It's organic, all natural. And these people have been distilling these type of gins up there for 1,000 years or more up in the mountains, and they've come up with just a phenomenal gin. It's in some of the finest restaurants in Houston now. If you get a chance, try it out. It's receiving rave reviews. It's Rangoni Alto Gin. Look for the kingfisher bird on the label. You can get it at Specs, I think downtown, and Total Wine, and many other places around town. It's Rangoni Alto Gin. Now, we're talking about the market. We've had market's up about 10%. And, many the precious metals are up huge. We've talked about that. One thing, we're coming into a seasonally slow time in September with the typically in September, October, particularly the big institutions start moving things around a little bit, getting ready for next year, taking profits, taking losses, and that's when you have market sell-off. Typically, September is about the worst month of the year. We looked at our stuff and we've had a very, very good year, and we put a hedge on Friday, just because we're just really up quite a bit, and particularly precious metals and other things, and we thought we wanted to do something to just kind of basically just to stabilize the portfolio to some extent on a pullback, and so it's just I think we're seeing some slowdown out there, and I think I'm expecting a little slower economy into the fall, and then people, if the Fed cuts rates, it's going to be concerned. Just, hey, how bad is the economy? The jobs number wasn't good, and so we'll have to see on that. But the other thing to keep in mind is the world moves so quickly nowadays. And everything is interconnected and is using AI and everything else, which means everyone's going to react the same way. And if you look at the market, it fell when Trump announced those tariffs. It fell about 10% in about 3 days. And it was already selling off before that. It ended up down, I think, from the peak down over about a month, almost 19%, and it came back up and has had a huge, one of the biggest runs off of I think a 15% correction in history. But it fell like in 3 days about 10%. I mean, many things were down 15% in 3 days, and I think you've got to be very cognizant of that fact. And so if you want to adjust things in your portfolio, you're going to have to be extremely quickly, or you're better off in many cases adjusting things as they go. Nothing's ever do I dump everything or do I go all in? That just becomes an impossible decision, which you can be right once and you can be wrong the next time, but you can scale in and scale out and do different things like that. And I think that's a good way to go. But I do think people have to be real cognizant of the fact that when this thing goes down, it's going to likely explode down the volatility is going to be tremendous. People forget the S&P is up about 10%. Okay. As I said, from the top, it went down, I think 19% or something like that in a matter of a month or so earlier this year. And so that's just something to think about. Again, this goes back to this broadening out and really understanding what assets will move kind of counterintuitively to the market. And it used to just be you could buy the 60% in the S&P 500, then go buy long bonds. If the market ever sold down, the long bonds went up and anchored the portfolio and stabilized it. That's a little different thing nowadays, and that's something that's not quite the same. And I think you've got to broaden it out to different other asset classes to kind of achieve a more stable portfolio. And I think this is going to be something that's going to kind of continue to be an issue overall. If you look at that February time frame, the dollar, when the market sold off, the dollar sold off as well. And that, again, that's unusual. When there's a big sell-off in the market, the dollar actually goes up. And that didn't happen this time. And so, again, that broadening out of the portfolio into different asset classes. If you look at the gold actually shot up during that time frame. And so, which I think it's liable to be in a pretty good place. It's harder to say, hey, look, you need to be in the gold sector right now because the market might sell off. You're like, wait a minute, Ted, gold's up, 30% year to date, 36% year to date. So it's a little tougher thing. But I want you to understand it's the importance of. I think going forward, I think more interesting. I think oil and gas is going to be interesting in here somewhere because if next time the dollar sells off, it's going to stabilize the oil and gas market, and I think that's going to be interesting. Anyway, if you've got any questions or comments, this is going to become the last segment of the show. You want to get in here? It's 713-339-1070. Hopefully, we can take calls on that. And what else do we have here? This market appears, we're saying that this is more like a 1970s market where you really have a lot of issues with currencies, a lot of issues with debt. Keep in mind, Nixon took the U.S. off the gold standard. Then they had the oil shortages in the 73. I think this time it might be electricity shortages instead of oil shortages. And during that time frame, it was interesting. If you look at the stocks that really did well, it was value stocks. It was small cap stocks, REITs, commodities, real estate, energy, copper, cash. Those things did pretty well. And so tech was actually the worst. Something to think about. And so I think you want to continue to look in some of. I was doing some research the other day. We're in I think there was 4 stocks we're in that the PE ratio was about 9 on them. 4 stocks, and I think 3 of them I thought were reasonably good growth stocks over the next 4 or 5 years. One of them was more of a play that one commodity might go up, but the other ones actually had growth. They were expanding the number of stores or putting a new mine in or field or whatever. Big things were happening, maybe not this year, but next year or the year after, that were kind of game changers in the companies, and they were at 9 times earnings versus something like an Apple computer at 35 times earnings. I think in my Max Out Savings report, we talked about Palantir. It corrected like 10% or something. And I'm like, you can now pick it up for 240 PE ratio on it. And it was interesting on I think it was Salesforce. I think Kramer was talking to the head of Salesforce or one of these companies, ServiceNow, one of the two, and he was saying they're much cheaper and they do a lot of work for the government too than Palantir's. And they're like, yeah, we both seen the price list at Palantir and it's super expensive. Things are going to come down. Same with the chips. If you look at NVIDIA is a great company. They're the leader in the chip sector, but Apple's trying to come up with their own chips. Tesla's trying to come up with their own chips. Other companies are trying. I think AMD wants to come up with their own chips. Alibaba is going to come up with their chips. Yeah, that doesn't even include, the other semiconductor companies in China, Huawei coming up. So there's other people are coming up with the chips. And again, you're talking a $4 trillion company here. These are massive. But the size of the U.S. economy is about $25 trillion. And it's like 1/6 of the U.S. economy on a valuation basis. And so you got to ask yourself on some of these really big companies, if you take, I think Microsoft, I think Microsoft's got like a $3 trillion. Between the two of them, it's a $7 trillion market cap. That's probably about 25% of between the two of them of the whole U.S. economy. Well, when people start selling Microsoft and NVIDIA, where's the money going to come from? If $7 trillion, if it's about $7 trillion worth of market of people want to sell, where's the money going to come from? And the answer is it's not. There's not enough money in the world to support it all. And I think that is the important thing. So it's been our philosophy, really. You have to sit there and just be much more broad-based with your retirement to protect it from these type of events. And I think we have a lot of things coming up here. We have wars in Ukraine. We have Israel war. We have what's going to happen with China. All of these things happening. We got $37 trillion worth of debt. We have tariffs. We have a trade war. We have commodity short. All of these things. And we have a real estate market that's slowing down substantially. This is not the bedrock of bull markets after you've had basically a two-year run on the upside. So something to think about. Came across some interesting statistics on silver. I think going forward, silver's still the best one. It typically has hit 50. If you go back over the last 50 years, silver's twice made a run to 50 or close to it. If you put any type of inflation number on silver, it looks higher. But here are kind of some of the numbers on over the last 4 years. The demand for silver has had a cumulative deficit of 678 million ounces, and they're projecting a deficit of 120 million ounces this year. And this is one of the reasons silver is going higher. But once photography went on the way silver, the demand for silver dropped off. That's changed, and now we have solar energy, we have AI, we have electric cars. All these people demand defense work, big amounts of silver, and there's just a shortages of it. And so I think silver looks like the better play out there overall. The gold to silver ratio is about 86. Over the last 50 years, that's traded between about 50 and 80, that ratio. So I think the silver is one of the better plays out there. I think that's going to be interesting. The housing, as we said, we're still expecting housing to continue to slow down. Trump's going to come up with a housing proposal here probably sometime in September and October. They're going to have to come up with something to try to stabilize the market. That's going to be interesting. So we just have a lot of interesting things happening in the markets, a lot of movement all over the place, and we just felt it might be a little better to put some hedges on. Look, the Fed's likely to cut rates, and it's likely to push it higher, but we just really wanted to kind of continue to manage the risk with our portfolios overall. What else do we have? We have our free Max Out Savings Report, which we send out about once a month. If you'd like a free copy, It's free. We don't call you up. We don't bother you. We just send it out once a month. I think we'll send out 2 this month. It just go to the website, maxoutsavings.com. It's maxoutsavings.com. If you need some help with your retirement, you can go to the website, get the phone number, give us a call, or send us an email, and request an appointment, and I'll sit down with you here in Houston personally. Our offices are here in Houston, Texas, and show you how we manage retirement money using our value investing approach. It's almost like an alternative. We're not really in the S&P 500. Most managers out there are simply shadowing the S&P 500, and we don't do that. Like I said, I think this decade is really going to be marked on performance of the S&P 500. We try to really broaden out the assets in the portfolio to try to get a more stable portfolio, and so this is something we kind of work. I mean, we're up pretty substantially this year, but and so it makes my job tougher. But we really are always trying to, as these changes hit the market, we try to get you ahead of it. We try to write about this in the Max Out Savings Report ahead of time. We were writing about gold and silver. We've been saying that for a while. We've had massive returns on that. We in 2007, longtime listeners to the show know in 2007 we said there was going to be failures of the investment banks, and that's what and we explained how it was going to happen. Unlike most people, we really try to tell you what we think is going to happen and why, and we try to put these proposals into the Max Out Savings Report and into the retirement management that we do. It's almost more somewhat alternative based to try to get better returns with a lower amount of risk. Anyway, so if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. And sign up for the free report. If you need some help, I'd like to help you out. We're here in Houston. Remember our motto and philosophy, which is to save aggressively and invest conservatively. And this should be your motto and philosophy. Save aggressively, invest conservatively. That's the key to building up wealth over the long term. Once you put away that 10% plus the company match, this is the minimum, into your plan, then you can spend the rest of your money. But you know your retirement will always be going, it'll always be growing. And then when you decide to retire, you're going to have enough money to retire. But you have to take the first steps. And if you're underneath that limit, now's the time to go to your HR person and increase it. Anyway, I hope everyone has a great weekend, and thank you for listening to the Max Out Savings Show.
Ted Gioka on AM 1070. The Answer.